everyone. Welcome back to Market Talk Monday with Isaiah Porter, Foundations Investment Advisor. How do you like that sound? Does it drive you crazy?
Mm-hmm.
Dad, please stop. All right, Isaiah, catch us up on the week past. Looking back in that rearview mirror, what did we see happen in the market?
Same old, same old.
That is the crazy answer, right? That's the short answer. Let's dig in more to what same old is.
Yeah, so what we saw last week, most of the Mag 7, if not all of the Mag 7, reported their earnings reports, just driving the markets really. And we saw another conversation with the Feds that quantitative tightening is also ending. The end of quantitative tightening starting December 1st, 2025, so going into an easing market.
So
where
that
the money supply opens.
That 25 basis point cut by Chairman Powell and the team at the Federal Reserve, by December, we're basically going to be back to where we were before the rate hikes continued.
Mm-hmm.
Okay, tracking with that. So the market's still driving through even some potential bad news in the market. We're still seeing that equities are just continually going up.
Yeah.
What are some of the concerns for you with, not sounding like negative Nancy, but what are some of the concerns of when this ride stops? What should clients be prepared for on the downside of this booming market?
I mean, the old saying, the higher it climbs, the harder it falls. So yeah, you should be prepared and always be diligent in the event of a downturn happening. It's not if, it's when it happens.
Yeah.
But there's other things happening in our economy, like we talked about earlier today, and over the weekend we talked about the government shutdown and the funding that government employees bring to the bank. So the banks are missing out about 1 million employees that are bringing money to the banks, and also
Talking about the Fed employees.
Yep.
Yeah. Okay.
And also we have the SNAP benefits as well that are going away. So the banks are losing out on large deposits of money. So it makes the velocity of money at the banks slow down. So it makes even though that they're easing and there's quantitative easing happening December 1st, the money supply is still not the same as it was 3 months ago.
So the government's handing out money, and that money handout actually supports public and private companies. It supports business. So when you're feeding those in need, they're going to the local store, buying goods to nourish their family.
Yep.
Whether it's good nourishment, bad nourishment, that's a whole another political talk. But that money in motion is being frozen right now.
Yep.
And there are some people who have concerns that that's putting pressure on banks and not having that flow of money or velocity money in their banking channels. And there's a potential where, as people, those million employees who have no income right now, they're going and depleting what? Their savings.
Yep.
And so that's less money. So the federal government says that for every dollar that's on deposit, they will lend to those banks in that overnight lending, or the overnight lending capability based on what's on deposit. So if deposits are shrinking, there are some who are arguing that that could cause another unintended economic meltdown.
Yep.
So it's super important then that the government figures out a way to set their political differences aside and pass a spending bill.
Yep.
That's what we're coming down to.
Absolutely. And when you ease the money supply, you're stimulating the economy, providing more opportunities for credit. So when you have credit, people come and they use that credit to go buy whatever. They could be buying goods and services, or some people could take it and borrow on margin and trade and stimulate the economy in that way. And that's a good thing for a short-term fix, and I think we could see a short-term bump in market performance from that.
Yeah.
But again, once that credit runs out, then you run into the same problem we're facing right now.
Yeah.
People are overborrowed, over-leveraged, and there's more debt than there is income. So that it's a perpetual cycle that goes on and on and on and on and on, and it comes a point to where you have to change something or change
Yeah.
behavior or do something, so that way those actions don't repeat themselves. But as history doesn't always repeat itself, but leaves clues.
Massive clues.
Um,
To that point, I shared with you there's a book that's been published, and you and I have been talking about it for a few weeks now. We're going to put this book in the link for you guys to go educate yourself. 1929, Inside the Greatest Crash in Wall Street History and How It Shattered a Nation. What I actually found interesting, Isaiah, about this book, and this is written by Andrew Sorkin, who most of you may know that name from CNBC if you watch any of the financial channels. He's a reporter for CNBC. Super bright, highly educated guy, too. This book, I would agree with what the Wall Street Journal said here. It's one of the best narrative histories, or narrative of history that I've read in a long time. He also wrote Too Big to Fail. So we'll make sure we put this in the link. Guys, let's add this to our website, too, as one of my library favorites right now. Will be awesome. But chapter 1 and the prelude to this book, he actually talks about the early 1900s.
mm-hmm.
And in the early 1900s, before even federal income tax was instituted, in the early 1900s, there was an issue with our banking system and the way credit was issued.
Mm-hmm.
And there's one man in history who was really credited with saving the banking system as we know it today, and that's J.P. Morgan, the original John Pierpont. I can't remember J.P. Morgan. Look me up, guys. Fact check me on J.P. Morgan, the original founder of the House of Morgan.
Mm-hmm.
There we go. John Pierpont Morgan was the original. His son Jack took over the bank later. But in the early 1900s, around 1907, there was a credit problem, which is wild because in 2008,
Mm-hmm.
we had a credit problem in our country that almost took down the banking system again, 100 years to the date
Mm-hmm.
of a similar act back then. And now here we are, 17 years later, 2025, and we're in a booming market, right? The
Mm-hmm.
market since 2009, since the recovery, we've seen nothing but the markets going up.
Yeah.
And so what Sorkin is talking about in this book is something that you and I have been discussing. And we've got to ride the highs, right? We've got to have clients exposed to the upside potentials of the market. But the record we sound like sometimes is the brokenness of it is, hey, Isaiah, we got to look for ways to mitigate and minimize downside risk when they occur.
Mm-hmm.
And so this book talks through things that happen in the market, both on the bad side and then what was done to, and I won't create the spoiler alert along our market commentary. I'll share more as we go, but I encourage you to read and look at this book. Thoughts?
Yeah, I mean, I just had a bit of a joke. It's kind of funny. It's like we're in a 100-year simulation. You see 1908 to 2008, 1929, 2029. It's funny.
We're coming up on a period of time where it's those who are informed
Mm-hmm.
and those who know, if you can use logic to overcome your emotion. There's a lot of emotion in the stock market right now.
Mm-hmm.
We actually get phone calls from folks saying, I want to make more money. I want to be in the market. And I get all of that. And it's important. And there's nothing worse than watching market values go up when you have a client in a fixed account.
Mm-hmm.
And you're saying to them, hey, there's a reason why we have this fixed account.
Mm-hmm.
There's a reason why we have this protection against downside. Because if we go back and look at when the market finally did correct, 1929,
Mm-hmm.
it took away 80% of the market's value from 1929 through 34,
Mm-hmm.
the market gave back almost 80% of everything it gave you in the roaring early 20s. It punished you in a 4-year period.
Mm-hmm.
And if you're retiring within 5 years and you hit that phase again, the bad news is you're not going to retire
Yeah.
if you're exposed to all of that risk. So the reason we do this market commentary is to keep you updated, to keep you informed, and to say, look, the key to winning is what? It's being
Diversified.
diversified. We have to have diversification. We have to have non-correlated assets along with our correlation and those that are correlated to the market. So again, we hate sounding like a broken record, but we wanted to give you some things to read and to ponder and to make yourself aware of what's going on in the financial markets. Because right now, it's all good news. Even with a government shutdown,
Yep.
the market's still
Performing.
So we'll see this week moving forward what we say next week. But it'll be an interesting week, in my opinion, to see how with SNAP funds not being there, with 1 million people out of work,
Yep.
federal employees, to see what's happening with the Federal Aviation Administration and workers being taxed there in that administration, where in some cities like New York, they're operating at 20% capacity,
Mm-hmm.
is what I'm being told and what I'm reading. Haven't independently verified that, but these are things that, to me, make me a little worried about what the market's going to look like in the next few weeks. So it makes me sleep well knowing with our clients, Isaiah, that we have utilized diversification in a way to minimize the downside risk of when the market does actually pull back.
Yep.
Parting thoughts before we go today.
Nope. Just be diversified. Don't put all
Awesome.
your eggs in one basket.
Great advice. Hey, thanks for paying attention and following us. Please hit the like button, hit subscribe, and share it with your friends, and stay educated.
Yep. See you in
Thank
the
you,
next one.
guys. Love you.